Welcome back to our next session, which is Unit 2.7. We are busy with the insurance products and the Long-Term Insurance Act. In the next section, we're going to discuss Long-Term Insurance Act and obviously its impact on life insurance products. The Long-Term Insurance Act of 1998 governs the long-term insurance industry. This act covers various aspects of the insurance industry and is divided into parts 1 to 9. Only part 7 is discussed in this unit. Part 7 deals with business practices and policy protection. Right, so we're going to look at parties to the life insurance contract and then protection against insolvency. Right, the following parties can be involved in a life policy. There is number 1, the policy holder. For example, the owner of the policy. This is the person who takes out the policy with the insurer and originally owned it. It is he or she is the only person authorized to make changes to this policy. Then there is the payer, usually the policy holder who pays the premium, but a third party may pay the premiums on the life policy. The responsibility would then rest on the policy holder to ensure that the premiums are paid by that third party. There is also the life assured, also known as the insured. This is the person whose life event, such as a death, will determine the provisions of benefits by the insurer, which is the sum assured. If the policy holder is a different person from the life assured, he must have an insurable interest in that person. We have discussed insurable interest earlier. There is a person or persons to whom the benefit is payable, which is the beneficiary. This person they refer to as the beneficiary. The beneficiary of a policy can be the owner, the insured himself, or another nominated person. And then there is something we call a cessionary. This is a person or institution to whom the rights of the policy have been partially or wholly ceded. One instance here is like to cede a policy to a bank for a loan, a home loan, or whatever type of loan, and then they take this policy as collateral security, so to ensure that you do pay your money back. Right, cessions. Life contracts may be ceded in full to another person, to a financial institution, as explained to a bank, as security against a loan. There are 2 types of cessions. The one is an outright cession. This occurs when policyholders, also referred to as the cedent, cedes or transfer all of his rights to the policy to a third party. This cession can be in the form of a donation or in terms of an agreement of sale. The cessionary then becomes the new policy owner. Some time way back, they used to sell a lot of what they call second-hand policies, where you then buy the policy from a policy holder. They cede the policy outright to you. You then become the new owner of the policy. You pay them a sum of money for the policy, and then the benefits of the policy, the payout amount on the policy, then rightfully belongs to you as the new owner. Then you get security cessions. This occurs when the policyholder cedes the policy to a third party, normally a financial institution, as security for a loan. It's also known as a collateral cession. The policyholder does not cede all of its rights of the policy to the cessionary. The cessionary may only keep the policy as security until the debt has been redeemed. In the event of the debt not being redeemed prior to the death of the cedent, the financial institution may only retain a portion of the policy equal to the outstanding balance of the debt. So let's say the policy is valued 100,000 in the cash amount in the policy, and you owe 80,000 at the bank. Then the bank can take the 80 and the other 20,000 must then be paid back to you. The balance of the policy proceeds, if any, must then be reverted to the original owner. If you passed away during this period, then obviously that balance will be paid into your estate. Right, protection of policies against insolvency. Now, Section 63 provides protection against the claims of creditors to certain policy benefits. The protection applies to policy benefits provided to a person under one or more assistance, life, disability, or health policies in which that person or the spouse of that person is a life assured and which has or have been in force for at least 3 years. So you see there's a limitation here. If it's not 3 years, then they can lay their hands on that policy, but after 3 years, because they say you don't plan insolvency for 3 years. The protection also applies to assets acquired exclusively with those policy benefits. The protection does not apply in respect of a debt secured by the policy. If the protection applies, the benefits will not be available for the purposes of payment of that debt. Right A, during his or her lifetime, it will not be liable to be attached or subject to execution under a judgment of a court or form part of his or her insolvent estate. That's if the policy is older than 3 years. If, upon his or her death, if he or she is survived by a spouse, a child, a stepchild, or a parent, the protected amount in a deceased estate must be paid to the surviving spouse, the child, the stepchild, the parent of the deceased. Right, protection of policies against insolvency continue. The protection also applies to benefits and assets acquired solely with the policy benefits for a period of 5 years from the date on which the policy benefit was provided. The person claiming such protection must prove on a balance of probability that the protection is afforded to him or her under this section. Furthermore, the protection will not apply if it can be shown that the policy in question was taken out with the intention to defraud creditors. The person claiming protection under Section 63 must prove on a balance of probabilities that the protection is afforded to him under this section. In a case Peterson versus Shrosby, N.O. and others, Shrosby, N.O. and versus Love and others, the Supreme Court of Appeal held that Section 63 does not purport to divert the proceeds of an insurance policy from a nominated beneficiary to the insolvent estate of a deceased policyholder. The court reasoned that in the absence of Section 63, on the death of a policyholder who has nominated a beneficiary to receive the policy proceeds in the event of his death, the trustee of that person's insolvent estate would not have any claim to the policy proceeds, nor does a trustee by Section 63 become a creditor of the nominated beneficiaries. Section 63 does not vest the trustee of the insolvent estate of the deceased policyholder with any interest in and the proceeds to that specific policy. Right, Section 64 of the Act provides that where two or more long-term policies referred to in Section 63 and held by the same policyholder are attached in execution of a judgment or a court order at the instance of a creditor or the owner of two or more long-term policies referred to in Section 63 is declared insolvent in a court, and only a part of the aggregate realizable value is protected under 63. The judgment creditor or trustee of the insolvent estate, as the case may be, must determine which policy or policies can be realized. Policies on the life of a minor. Long-term insurance policies may be taken out on minors and unborn children's lives. The amount of cover that can be taken is limited depending on the age of the minor or the child to be insured. The limitations that are in place setting out the respective maximum covers are: in the case of an unborn or a child under the age of 6 years, it's 20,000. In the case of minor children older than 6 but younger than 14 years, the maximum limit is 50,000. However, if the value of the total premium plus interest exceeds the above limit, that value will apply. These limits are in place to ensure that there is no financial incentive for anyone to harm children and relate to the primary purpose of insurance. which is to protect a person against financial loss. The death of a child causes a financial loss, thus the cover limits relate primarily to funeral costs. That concludes this section on the Long-Term Insurance Act. And it's important to note in the case of children why this limitation is there. It is to protect that child because there has been parents, and this might sound terrible, that has drowned their own child in a swimming pool just to get money from their child's life. Thank you for listening to this session, and let's see each other in the next one. Thank you.